Hello everyone, welcome to FISC Financial Strategy Consultants. Today we are going to study CFA Level 3 reading number 30 LOS 11 where we will study three basic methods of taxation, tax relief in double taxation. So first of all we will understand what is double taxation. There are three kind of conflicts which can arise when you are doing cross border wealth transfer or you are earning in multiple countries. One is residence conflict, where two countries present their evidence that you belong to their particular country, means you are resident of their country. So this is one of the issue where same individual is subjected to taxes in two different countries because they consider him as their own citizen. The second one is source conflict, where a same asset, single asset, is considered to be sourced from two different countries. So two different countries are saying that this asset belong to their country and therefore they are charging taxes on that particular source. This is called source conflict. The third one is residence source conflict, which is most predominant in this world, where one country where you are living, where you are earning money, is considering source taxation. So they are charging money based on your earning from that country. But the country in which you are the resident, they are having residence based on jurisdiction, where they are charging based on your income no matter from where you are earning it. So on the same income you have to pay two taxes. One is based on source jurisdiction, other based on the residence jurisdiction, and that's why it is called residence source conflict, and it is very difficult to overcome because in residence conflict you can prove that you don't belong to both of these country, you belong to only one of them. And similarly the source of income is only from for a particular country, not for both of the countries. So these are the things. Residence source conflict, we need some different methods to reduce those taxes, and there many treaties which are signed, there are many things which are going on to reduce the taxes. Three of those methods which use to reduce the taxes on double taxation is called credit method, exemption method, and deduction method. Credit method means that you have to pay only maximum amount of tax applicable to you, whether it is in residence or source. So the total taxes is based on whichever is maximum in residence and source. Suppose for example the resident country imposes 50% tax and the source country source income has a 40% tax on it. So what happens is that the resident country will consider that you have already paid 40% to the foreign country from where the income is generated, and they only charge you the rest of the 10% for their because you are the citizen of that country. So that's called credit method. In the exemption method, they completely remove the taxes you have to pay based on the income you earn in a foreign country. So the total tax is the tax on the source income. Singapore and Thailand are such countries where this thing happens. So from the previous example, the maximum taxes which you have to pay is 40%. And since I mentioned Singapore, Thailand, you already know that most of the companies get registered in Singapore but doing business globally because they know that they don't have to pay the taxes to Singapore based on the income they are going to earn in any other country. The third one is deduction, tax deduction method, which says that total tax won't be the sum of tax on residence and source, but it is based on a different method, a different kind of calculation. In the from the previous example, if you go 50% resident, 40% source tax means 90% taxes, but in deduction method, the only tax which you have to pay is 70%. That's all which we have to study in this video. Please comment to let us know how you feel about this video, how we can improve it. Please like this video and share to as many people as possible. And please subscribe the channel if you haven't. Thank you very much.